Okay, in theory, we're live. I'm gonna wait until we actually get confirmation that we are. Just gonna wait from.
Yeah. Let's see.
Uh, yeah. Oh, actually, yeah. I was watching the actual press conference, which said there was 14,000 people watching. I doubt that's us. So let me get the actual video.
By the way, I don't see your camera, just so as you know.
Yeah, you won't see it. The guys in live was it. It's fine.
Mhm.
All right. Yeah, I think we're live. Okay, good, cool, and.
Okay.
All right, I think let me share my video stream as well. I'll just put this very low music as we wait 10 minutes. All right, cool. Welcome everyone. And yeah, we're just gonna do a quick chill live with everybody from Cryptoracles here today. Probably just gonna look at some of the charts and just have a chat about inflation and what we've seen in the markets happening in the last couple of weeks, what we think is gonna happen in the future. We just released a pretty good first version of our, well, I would say first sneak peek of the newsletter we're going to start releasing. So we got some insight out of that, and we can talk about it. We can talk about how some of the cryptos moved, some of the markets. So maybe we start with that. Maybe we take a look at Nasdaq. I think since the middle of June, I think we've seen a bit of a rebound here, and it's been trading in this uptrending channel. And then today we've been up 3%. So it's been a pretty positive week. We've seen many earnings releases, some really good, some really bad. I think Snapchat was down 38%. And then today we've seen Coinbase stocks were down 20%. That's because I think they're going to be investigated for some of the listings. So some good, some not so good, but I think overall we had a pretty positive week, which puts the Nasdaq, I think, on a third week in a row, which has been printing for the upside. Yeah, Edo, do you want to chat about anything you guys put
Yeah.
in the? Yeah, go
Yeah.
ahead.
Yeah, sure. Yeah, as we see from the chart, for instance, of the Nasdaq, and as you said correctly, like in the last month, we have seen like a huge rally, I'd say, but like, yeah, it's still not so certain how the market's gonna develop, and especially this type of meetings, like the one of today, are very, very important to assess what is gonna happen in the markets, and yeah, like today, like this week is also pretty important because of the corporate earnings. Like we know that I think the most important day is going to be tomorrow, which because Amazon and Apple are releasing their earnings after the bell, so that is going to be a huge signal of what is going on in the U.S. economy, which we know usually drives the entire global economy. So let's mark down tomorrow's
I
because it's
think
going to be pretty important.
I've got a question here for you, like on this stuff. Like, how do we see the whole economic outlook? So we definitely seen a rebound from early June, but inflation is still high. We're seeing multiple countries around the globe getting higher and higher in inflation, defaulting on their own debt. We've seen Turkey. We're talking about Zimbabwe today. I mean, I know it's an African country, so we don't always look at we always forget about the A in EMEA, but it is there, and their inflation was insane. I think they were down 60% now. Turkey was 80%. So we're seeing countries around Europe and around the EMEA that are definitely being impacted. So despite this rebound of the markets themselves and positive earnings, do we see this as a natural switch to a possible upside and an improvement for the rest of the year, or do you think we still have a lot to
Mhm.
face? How does this relate to
Yeah, this
inflation,
is
basically?
indeed. Yeah. No, this is indeed the key question. Like, we know that at the moment the main issue to solve is the inflation rate, because usually it tends to be like the central banks want the inflation rate not to exceed the 2% bound. So right now, last report was 9.1% for the US. So this is pretty huge, and I think that is why, of course, the Fed is is actually raising rates. But yeah, it's difficult to say that. Like for sure, inflation is sticky. So when you raise rates, it's not instant the outcome of your action, but it actually takes more than a few months to have the economy slow down, you know.
Yeah.
So it's kind of like I don't honestly, in my opinion, I don't see the market going up in the last part of the year, because this inflation is the main issue, and like if they want to keep this inflation down, they need to raise rates, which is not positive for the economic outlook. But like,
Agreed, yeah.
what's your opinion on this?
I mean, to me, it just looks like a relief bounce from the latest
Yeah.
downtrends that we've seen. I wouldn't take it as a inversion of the trend in the markets, like from a technical standpoint. Right, I think we got live, so I'm going to put myself on mute and just boost the volume, and I guess we can chat about and comment live as well. I think we should also explain a little bit how inflation works and what the interest rate hikes are for. I think not too many people understand this fully, so maybe after we can do a little bit of that. I mean, I guess until Powell comes on stage, we can wait and chat a little bit more. But essentially, the idea behind these rate hikes, guys, is that we want less money to circulate. If you have less money in circulations, you tend to decrease inflation, and by raising interest rates, that's what you achieve. But I can give you more details at the end. All right, let's watch this together then.
Yeah.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point.
Just going to take a second look at the Nasdaq printing on the actual announcement. That's pretty interesting to watch live. Look at that. That's a pretty good move, and that's Bitcoin as well on the side. So Bitcoin hit about 3% on the announcement, but is now breaking that, going up. So I'm pretty glad we opened a trade live for the guys that were here earlier. So I'm going to go back to the video now, but I think I'm going to keep this on the side. It's really interesting to watch the Nasdaq move at the same time.
It's crazy.
Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer-run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, so we got some Q&A. I think we can comment through this as we listen through, and then we can probably chat about a couple of questions we may have.
Rachel Siegel from the Washington Post.
Some of these questions are actually quite interesting.
If you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the.
That's a good question. Like, I was also expecting a full percentage point, to be honest. There was a part of me that was expecting that.
Of a stronger hike at this meeting. Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks.
Right. I think you're gonna pause that for a second. Yeah, I think pretty interesting. Exactly what we knew what we was gonna say. Amazing to see the Nasdaq going up 1.3% in 10 minutes. That's a sight. It's actually an absolute sight to see. One question I had was something worth chatting about is we talk about the Fed, we talk about inflation in the United States, but the inflation in Europe, it's slightly different. Like it's different numbers, it's stacked at different times in different ways. So Edo, you know a little bit more about this. Do you want to give it a bit of an overview of how this works?
Yeah, sure. The main difference is that the inflation in Europe is mainly driven by of course the war in Ukraine, which affects supply of food, but also of commodities, because for instance, I think the sharpest the sharpest instance of this is the natural gas price, which is in these days is at the all-time high at least in the last decade. And that is of course because of Ukrainian war and the Russia supply, which was cut off by the EU. So the main thing is that why did the ECB did not really raise rates as much as the Fed? The main thing is that one thing is that yeah, the policy in the EU is really fragmented. So the situation is very different from country to country. So that makes more difficult to have a more united opinion on this. But most of the, like, above all, the main thing is that inflation is mainly driven by the Ukrainian war. So rising the interest rate wouldn't really affect things, at least in the short term. So that's why they just raised the rates by 75 basis points.
So what's the total in Europe at the moment? It's just 75 in total, or?
Yeah, it's 75. I think they raised rates the first time in July.
So I think, like, given there is a delay in all of this, right, and we're seeing inflation in the US going up to 9%, we're seeing inflation in Europe up to 9%, but interest rates are only 75 basis points in Europe, or an average 75 basis points across Europe. I think we could see inflation much higher than what the US may face, to be honest, at least for a month or so, or a couple of months.
Mm-hmm. Yeah, and also the other factor is that European economy right now is not really in a very positive period,
Yeah.
Also, like, first of all, because of the war. So that makes a bit more difficult to take these kind of decisions for the ECB compared to the Fed, which of course we know that the US economy is way stronger than the European one, at least at this moment. And this is also shown by the Euro-US exchange rate, with the euro, which is at the lowest points since the 2001. So
actually, that's something worth pulling up. Let's see if we can find a chart. USD. Sorry.
I think it's Euro USD.
Is it Euro USD? Yeah. Okay. Let's see if we can grab it. But yeah, that's an interesting one. And yeah, as I was saying before, the whole point, guys, of raising inflation. Sorry, raising we don't want to raise inflation. We want to raise interest rates. Basically, you want to have less money circulation, right? So if you have less money in circulation, you lower the amount of spending, and you effectively, it's like constant when you lower inflation. So the way it works is the central bank will have an interest rate for giving loans effectively, and retail banks like Barclays or Goldman Sachs or JP Morgan, or in the US, and UniCredit in Europe, for example, they all give you a certain rate when you take a loan, because the rate that they give you, it's higher than what they can get from the central bank. But when interest rates are hiked, and when we have our inflation, what effectively we do is we give more. So the central bank will give more than usual to retail banks, right? So instead of getting it on 2%, they will get 5 or 6%. So instead of giving a loan to you as an individual, they would rather keep the money in the central bank. So a loan will cost you a lot more than it would cost you normally. Because of that, especially in the housing market and real estate, what happens is that people that want to buy a house will find it a lot harder to buy a house, right? So that's why we see mortgage rates going up, because it's the direct consequence of this, and then people will unlikely to take a mortgage to buy a house. People who have a house, if they want to sell it, will have to drop the price, because there's just demand and request in the market, so they will have to drop the price if they want to sell it. And then when it comes to rentals as well, the rents will increase and go up, so people are less likely to move, less likely to spend more or rent a house or move and rent a different house in that period of time. So this is one of the main consequences, one of the biggest ones on the retail market, on the real estate market. And then the other one, of course, is prices of goods, right? So a lot of the goods will increase in price simply because of this as well. Like, it's a big look. A lot of the companies that are producing primary goods and staples, consumer staples and discretionary, they will face the same issues. They won't easily get loans. They will have higher rates or higher payback loans. So they will effectively face the same issue, and they will have to raise their prices. And by raising the prices, people will start trying to save more and buy less, and less money will circulate, and eventually bring inflation to a lower point. So that's kind of the idea. That's kind of how this works and why we have these rates. Yeah, so is there anything else we want to chat about? Otherwise, I mean,
One question about this. So
yeah, go ahead.
Does this affect salaries as well?
It's a great
Or is
question.
it just, yeah.
Edo, you have more insight than I do maybe on this?
Yeah, I mean, like this could be answered really intuitively. Like if the rates are raised, in some sense, this comes at the price of slower economic growth. So, and in order to fight, of course, inflation. So slower economic growth basically would mean, less demand for new employees, for instance. And of course, the bargaining power of like the current employed people, it's not that high anymore, I would say, since they're all already in a shortage of employee. So yeah, I would say I don't think your salaries would go down, but like for sure there's gonna be much more friction in new in the employment rate, you know. So yeah, like overall it's not a very it's not positive for your salary. For sure you're not gonna see your salary going up because of this, I'd say.
Yeah, I think like if I may add just one thing, I think like the main thing to keep in mind is that again, like purchasing power that is going to go down, and the fact that this is going to influence also, like again, company earnings. That we can say, yeah, today, last days we have seen like super high and strong earnings. But what is going to happen? It's actually like going to change it in next months. So it's also like why this moment is reality like looks like a sort of moment of speculation for many investors in some ways.
Yeah, absolutely. I think one of the other things we're talking about is just, of course, at a much lower level, not on an economic scale, but is, companies tend to give raises in terms of your salary, usually by following inflation. So your base salary will increase by 2% or 3% based on that, right? It's very unlikely that this year companies will give raises matching inflation because they would have to give a 10% raise. And at the same time, they're also facing the same issues. So most companies, for example, will have loans, will borrow money as well for not necessarily central banks, but they will also have loans, and they will have to repay them back at a higher interest. So they're much less likely to put money forward to salaries or in that space. Then, of course, it depends in which market you are as well. It really depends what it is. But talking about retail as a whole, then yeah, so I kind of agree with what Edo said. Cool. I just pulled up the chart of the euro dollar. So, I mean, on a long scale, it just looks really sad. There isn't much that we can say. I mean, being European, this looks very, very sad. I think there was, this is something that a lot of people didn't notice in 2014, and that I discovered myself when I was doing my my degree. I mean, I guess I didn't do a degree in economics, so I know you may know about it, but in 2014, we actually had a bit of a crisis, and this is you can see this in many charts across Nasdaq, S&P 500, Euro dollar, and so on. And you can see here, I mean, the euro dollar went from 136 all the way down to nearly 1-to-1. And this was in 2014, so this was 8 years ago. So we've already seen things like this, right? And if we compare where we could go for now, we could easily go all the way down to 84 cents compared to the dollar. I mean, if we go 1-to-1, and at the time inflation wasn't as high either, right? And I think if we go all the way back to 2008, what happened there? So yeah, it's very similar. So we got 2008. Actually, if we try to look at some of the actual numbers, so the drop on the forex exchange was 20% drop in between euro and dollar. We're seeing 25% drop in 2014, and so far from the beginning of June 2021 up to today, we've seen a 20% drop. So the difference here is inflation. So inflation is much higher than it was at the time, right? Inflation is higher than it was in the 1980s at the moment. So now even if we're optimistic and we're looking at the same sort of drop in the value between the euro dollar, we're looking at a euro at 90 cents against the dollar. So we'll have to see, of course. I mean, it's markets don't randomly repeat themselves this way, but I think it's a good indicator of what happened in 2008 and 2014, if you look at the whole market. And yeah, anything else? I was just keeping an eye on crypto. So we looked at Solana before earlier. We did a couple of trades live before the Fed meeting. So this seems to be going pretty well. Ethereum, this seems to be breaking resistance, but we're looking at a small scale. But Ethereum did a very nice bounce. So it bounced off the, I think that's the 200 days moving average or 100 days moving average. Bitcoin on the 1 minute scale, it's doing exactly what Nasdaq is doing. Just we're talking about crypto. So Bitcoin is up 5%. Nasdaq is now up 1.6% from the announcement. I think that's absolutely crazy for a traditional stock market. And the other one I heard a lot of people talking about was Cardano, doing quite a lot of interesting moves, trying to break resistance. So we talked about this earlier. Cardano created a very solid support zone from mid-June up to today and tried to break resistance at about 51 cents multiple times and failed. And I think this is one of the biggest winners in the big cap altcoins. Is up 10% today, and I think it's up 6% since the beginning of the announcement. So doing pretty well. I think if this breaks the resistance on a technical point of view, unless we see a major shift in the market, the next target would be about 60 cents. So something to keep eyes on, and we'll definitely keep everyone posted in our community. Anything else you want to cover? Yeah, go ahead.
Do you still see like a strong correlation between cryptos and Nasdaq for the next few months, or?
Yeah, I think the correlation, it's due to the fact that cryptocurrencies are very they're not a mature market. So it's the same we've seen with gold at the very beginning, and if you go back all the way back to when gold started being traded, you see something very similar to the cryptocurrency market. Like any immature or not so mature market will behave a similar way, right? And in times of uncertainty, what tends to happen is that most of these markets will pretty much start trading in similar ways. And there is a couple of reasons for this. One of them is we've seen a lot of money being pulled out of the cryptocurrency space, right? So there is a lot of money going either in stable coins or completely out of the crypto space. And we've seen something similar in the stock market, partially similar in the stock market, where a lot of people will find an edge compared to stocks, and we move to gold, right? So we've seen a lot of money going out. So you reduce the volume, you start seeing a lot of trades and a lot of behavior that becomes very similar. First of all, when we saw a lot of inflow last year during the bull run in the crypto market, most of that flow and most of that trend was because we're seeing a lot of retail investors and big companies coming in from traditional markets into crypto. So there was a flow of money coming into crypto, and the volume drastically changed. Well, the volume you're seeing now, it's kind of a ratio on a different scale in between traditional markets and cryptos. So I don't see this changing until we get a period of certainty. Until we have uncertainty in the markets, I think this correlation is going to keep happening. And I mean, to answer your question, I think just for everybody's view, if we take a step back and look at Bitcoin on a 4-hour scale, and we look at the Nasdaq on a 4-hour scale, the two are pretty much 1-to-1. So if I just zoom this out a little bit, you will see that they follow the same exact pattern. So we got this uptrending channel. We go 1, 2, 3 bounces on the downside, two rejections from the upper side, and Bitcoin is exactly the same: 1, 2, 3 from downside and 3 rejections on the upside. So exactly the same. Even the move today, it's exactly the same sort of move. So yeah, I think this is gonna keep. We're gonna keep having this correlation until we are more stable as a whole.
Anyway,
Cool.
I think this is a sign of a mature market, though. Am I wrong?
In the crypto space or in the stock space, I guess we can't.
Crypto, as in like obviously being 1-to-1 to Nasdaq is obviously not that niche anymore, I'm assuming.
What I'm wondering here is, what you're saying makes sense, but what I look at is the volume, the market cap of the whole space, right? We're talking about $1 trillion. in cryptos, which is very tiny compared to traditional markets. So that's basically one thing. I think most of the correlation is due to very low volumes and uncertainty. So most of the moves are very similar to each other's. They're mostly driven by the same factors. That's what I'm trying to hint at here. I don't think that necessarily makes it a more mature market. I mean, it's kind of easy to be mature when the driving factors are the same and are very simple, right? Right now, the driving factors are all the same. It's the war in Ukraine for Europe, it's gas prices. For Bitcoin, it's mostly anything that happens in traditional markets and the whole economic outlook. There is differences, of course. We see single events that will drive Bitcoin up and won't move the stock market and vice versa. But as a whole, we're not seeing those big trends like, Tesla coming in and saying you can now buy Teslas with Bitcoin and the market moving up 10% in a week, retail investors flooding in. Those were unique events, the crypto space, that were moving the market in that space. And we're, on the long run, does create maturity that is individual to the crypto space.
Yeah, makes sense.
That's pretty much my take. Right, I think we got a few minutes before the call ends anyway, guys. So I just want to give a shout out to our group. So for the ones that don't know and are listening in today or want to watch this video later, we are building an entire website, entire platform where you can get market data, where you can get information about the crypto space, where you can get information about NFTs and anything that is happening in the markets. And we are going to do this through NFTs as well. We have a collection that we're going to drop at the end of the year, towards the end of the year. And if you are one of the NFT holders, you get access to all our channels. You get access to lives, M&As, questions, and entire access to our portal. So definitely could join our Discord. I will put the link in the description. Join our Twitter, come and follow us. There is definitely a lot of benefits from being in the community just by seeing around and learning a lot. Our whole focus is around education and trying to spread as much as we can the knowledge that we have in the space. So thank you so much, guys, for listening tonight. I hope this has been insightful and I hope you liked it. We'll do it more often as much as we can. And if you have any questions, just drop in the comment section down below, or feel free to reach out on Twitter, Instagram, LinkedIn, and Discord directly to us. Thank you very much, guys. And